Namaste, good morning. Welcome to this session where the primary intention is to understand at length assessment of firm's provisions. What are all the provisions covering assessment of firm? Followed by that, looking into the pass-through entities, that is the three trust of Securitization Trust, investment trust, and most importantly REIT, a business trust. And then also, if we get time, we will start the introductory part of assessment of companies. Well, assessment of firms, the holistic theory. By holistic theory, I mean wherever, whatever has mentioned, we will try to understand. Wherever in the law it has been mentioned, we will try to put it in this umbrella or this basket of assessment of firm. So, we are trying to understand the theory end to end, okay, wherever it has been mentioned, okay. And the first thing we all know is a firm will also includes LLP. We don't have specific provisions for LLP. Whatever provisions that are applicable for the firm will be applicable for LLP as well. Right. We are saying firm. What is a firm? What type of entities are known as a firm? The law provides three conditions in section 184. Three conditions in section 184 to say a particular entity is a firm. It should have a deed which should be a written deed. It should have a written deed. Partnership law might say that the deed can also be oral, but in income tax law, it's a written deed. The share of profits of the partners should be specified in the deed. The second condition is share of profits of the partners should be mentioned in the deed, which means the partnership law says if the deed is silent, the partners are sharing equally. In income tax law, say that the partners are sharing equally or 3:2:1, whatever is the ratio, and ensure that the deed is with the department also. So, three conditions are mentioned in the law to categorize an entity into partnership firm. Written deed, share of profit clearly mentioned for partners, and deed should be filed with the department. If all these conditions are fulfilled, then it is a partnership firm. Otherwise, I will call it only as association of persons and not firm. If all the conditions are fulfilled, I will call it as a partnership firm. If these conditions are not fulfilled, I will not give that entity the name of firm. I will just give the entity, even if one condition not fulfilled. Okay, I will give the entity the name AOP, Association of Persons. So, evidenced by a deed, share of profit, okay, all three conditions satisfied, it is a firm. Even one condition not satisfied, AOP. So, this is said in section 184. Then we will travel from the top of the law, whatever has been mentioned for a firm specifically. Whatever has been mentioned for a firm specifically. Residential status. If the control and management is wholly outside India, then it is a non-resident firm. We saw it. If the control and management is wholly outside India, it is a non-resident firm. Even if it is partly in India, it is a resident firm. Okay. But in terms of tax rates, etc., there are not much difference between a resident firm and non-resident firm. Do not worry. And section 10(2), this is exemption part. Share of profit of a firm is exempt in the hands of the partners. Share of profit of a firm is exempt because the share of profit is after the firm paying taxes. It is like dividend that may be distributed, may not be distributed. So after the firm paying taxes, so it is not taxable in the hands of the partners. Share of profit is exempt in the hands of the partners. Right. If I go to the next chapter in our line, salaries does not have a provision for firm, exclusively any provision for the firm. Partners' remuneration is not taxable as salary. We saw in section 28, any bonus, commission, remuneration, interest or any other payment to a partner is taxable only in PGBP. So it is not taxable in salaries. So salaries otherwise does not have any specific provision for the firm. It goes as it is. House property does not have any specific provision for the firm. It goes as it is. House property chapter also does not have any specific provision. So that leads us to PGBP. PGBP has one standalone section for firm, section 40B. Section 40 subsection B, one standalone provision for firm. Otherwise, PGBP has few aspects which a firm goes by. Starting from section 28, we know 28 defines any salary, bonus, commission or interest or any other payment to a partner from a firm is considered as business or profession or taxable under business or profession in the hands of the partners. We all know that. Then we came and saw something about proportionate depreciation. We came and saw something about proportionate depreciation. We all know this is a concept applicable for succession. This is a concept applicable for succession. What is succession? Amalgamation, demerger, all types of conversion. So imagine the three types of conversions I am saying. The three types of conversion. Conversion of a firm into a company. Conversion of LLP into a company. Conversion of company into LLP. Three circumstances I will tell you. Conversion of firm into a company. Conversion of LLP into a company, conversion of company into LLP. In all these three cases, depreciation will be worked out. Once more listen. Depreciation will be computed in the normal manner. For computing depreciation, there is no change. For computing depreciation, there is no change. Such computed depreciation will be distributed based on proportionate basis. What is proportionate? Effective usage period. We saw in PGBP chapter what is meant by effective usage period. the total number of days the asset has been used. So the computed depreciation. So for computation, there is no change. We all know that. Such computed depreciation will be distributed between the entities based on effective usage period. Based on effective usage period. That's what is this concept. The concept is relevant for amalgamation, demerger, conversion. Okay. Accordingly, where an asset is used by both entities, then depreciation will be computed ignoring the event. While computation, no change. The normal format of computation. Such computed depreciation will be distributed on the basis of their effective usage period. On the basis of their effective usage period. Okay, right, fine. So this is one thing we saw about the firm. Then 33, 35, 37, 40 and all are coming. Then comes 40B. Then comes the most important or standalone provision for firm, interest and remuneration to partners. What is the interest or remuneration that can be paid to the partners? What is the interest or remuneration that can be paid to the partners? Okay. So it starts with interest and remuneration can be paid only if it is authorized by the deed. Repeating, my dear friends, interest and remuneration can be paid only if it is mentioned in the deed. If the deed is silent, you cannot pay it. If the deed is silent, we cannot pay. The assumption is interest is not allowed or remuneration is not allowed as per deed. So, the first thing is it should be authorized by the deed. The maximum interest and remuneration, once it is mentioned in the deed, the maximum that is payable is either as per the act or as per deed, whichever is less. Once it is mentioned in the deed, if it is not mentioned, no remuneration. Once it is mentioned in the deed, the maximum payable is either as per act or as per deed, whichever is less. Whichever is less. Okay, that is the maximum that is payable. Fine. What if, please understand, what if the deed is silent? No remuneration is payable. Okay, deed should quantify. Deed should quantify. Deed cannot just say we can pay remuneration to partners and leave it. Deed should quantify. Then only I can compare between as per act or as per deed, whichever is less. A mere specification in the deed that remuneration can be payable as per income tax law is sufficient. You need not, by quantifying, I am not saying you should exactly tell the number. You can also say in the deed that as per income tax act it is payable. Anil Hardwares, we will soon see a case where they have held that a mere mention that remuneration will be paid as per income tax act is sufficient quantification. Okay. Once more, remuneration and interest is payable only if it is mentioned in the deed. If the deed is silent, you cannot pay. If the deed does not quantify, you cannot pay. If the deed says that it can be paid as per income tax law, pay. Then, remuneration and interest is either as per deed or as per act, whichever is less. Remuneration and interest is either as per deed or as per act, whichever is less. What is the interest as per act? It is 12% per annum. Interest as per act is 12% per annum. So if the deed says 10%, I can only pay 10%. If the deed says 15%, I can pay 12%, either as per act or as per deed, whichever is less. As per act, interest on capital is 12% per annum. As per act, remuneration is based on the book profit of the firm. Remuneration is based on the book profit. Okay, what is book profit? Profit arrived at after applying the provisions of section 28 to 44 before charging remuneration. Once more, we normally do net profit, add 40A2 disallowance, 40A3 disallowance, TDS default disallowance, capital expenditure disallowance, provision disallowance, less non-business income, which is taxable in house property or income from other sources, less depreciation as per income tax law. That is known as book profit. If they have already charged the remuneration, add that back. Okay, what is book profit? Arrived at as per section 28 to 44 before charging remuneration. We then understand it is after allowing interest on capital but before charging remuneration. Even interest on capital you should allow and compute. Okay, book profit means profit as computed under PGBP chapter after allowing interest but before providing remuneration. So, remuneration depends on book profit. Okay, it is again slab based. It is again slab based, where book profit is not exceeding 3 lakhs. Where book profit does not exceed 3 lakhs, 90% of book profit or 1,50,000, whichever is higher. Where book profit is only 1 lakh, pay 150. Book profit is 1,50,000, still pay 150. Book profit is 2 lakhs, 90% of 2 lakhs, 1,80,000 or 150, whichever is higher. So, where book profit does not exceed 3 lakhs, 90% of that book profit or 150, whichever is higher. Where book profit exceeds 3 lakhs. Up to 3 lakhs, the previous slab, amount exceeding 3 lakhs, 60% of such excess, 60%. So let us take that the book profit is 5 lakhs. Let us for a minute assume that book profit for remuneration for partners is 5 lakhs. So how do I compute? Up to rupees 3 lakhs, 90% of rupees 3 lakhs, which comes to 2,70,000, or rupees 1,50,000, whichever is higher, so 270. Okay, so 2,70,000. On the balance 2 lakhs, what is that balance 2 lakhs? Amount exceeding 3 lakhs. Total book profit 5 lakhs. Up to 3 lakhs you have, okay? On that directly 60%. Okay, so 2 lakhs into 60%, 1,20,000. Okay, 2 lakhs into 60%, 1,20,000. So I get it as total remuneration as per Act. Total remuneration as per Act becomes, okay, total remuneration as per Act becomes 2,70,000 plus 1,20,000, which is equal to 3,90,000. Okay, for a firm which is earning a book profit of 5 lakhs, they can distribute 3,90,000 as maximum remuneration as per Act. Now I will compare it with the deed, whichever is less. What is the parent law? Either as per Act or as per deed, whichever is less. As per Act, I get this. So I will compare it as per deed and determine whichever is less. So profit, once it is determined, 90% or 150, whichever. When will 150 be higher? If the book profit is 1 lakh. If the up to book profit being 155, 160, 90% might be higher. After that, 150 might be higher. After that, 90% will only be higher. And remember, even a loss-making firm can pay remuneration up to 1,50,000. Even a loss-making firm can pay remuneration up to 1,50,000. Okay, what do I mean by the term remuneration? What do I mean by the term remuneration? Other than interest, whatever is paid. Other than interest, salary, bonus, commission, or any other sum. Salary, bonus, commission, or any other sum payable to the partners is known as remuneration. Salary, bonus, commission, or any other sum. Okay, the allowable remuneration and interest is taxable in the hands of the partner under the head business or profession. We saw it in section 28. Salary, remuneration and interest is taxable in the hands of the partner under PGBP under section 28. We all know it. We all know it. Now, from the top, once more I am coming into it. Please listen. Remuneration and interest is payable to the partner provided it is mentioned in the deed. Deed can say that it is as per income tax law applicable, acceptable. But if the deed is silent or if the deed just says pay remuneration, I will not pay. It should quantify. It can say as per income tax law pay. Remuneration is either as per, remuneration interest is either as per Act or as per deed, whichever is less. Either as per Act or as per deed, whichever is less. As per Act, 12% per annum is the interest. As per Act, how to compute the remuneration? Remuneration is computed based on book profit. Book profits means after making all adjustments that are required to be made under PGBP chapter, after making all adjustments that are required to be made under PGBP chapter, except remuneration. So even after interest on capital, if the book profit, if there is a book loss, pay 150, no problem. If there is a profit and the profit is low, pay 150, no problem. If the profit is up to 3 lakhs of profit, 90% of book profit or 1,50,000, whichever is higher, paid. More than 3 lakhs, it is 60% of book profits. This is as per Act, either as per Act or as per deed, whichever is less. And what is remuneration? Except interest, whatever is paid. You call it by any name, it is known as remuneration. And the remuneration and interest that is allowed in the hands of the firm. Remuneration and interest that is allowed in the hands of the firm is taxable in the hands of the partners, is taxable in the hands of the partners under the head PGBP. Now imagine a circumstance. Imagine a circumstance that while drafting the deed, I forgot to put that remuneration clause. I forgot to put that interest clause. Or whatever I have put is, I put 10% per annum, 5% per annum. Some wrong amount I have put, or now I want to revise it. Can I revise it? Yes, you can revise it, no problem. But one thing which the income tax law ensures is, any amendment to this clause, which clause? Interest and remuneration. Any amendment to the interest or remuneration clause will be applicable prospectively and not retrospectively. Any amendment to interest or remuneration clause will be applicable prospectively and not retrospectively. You cannot go back and amend. From tomorrow it is so, you can amend. You can amend. I will take an example. On 1st of September 2020, the deed of the firm was amended to make interest on capital as 12% per annum. Till then, it was 5% per annum. The amendment was made in the deed with a retrospective effect from 1st April 2020. The deed which was having 5% interest per annum, interest on capital per annum, was amended to 12%. The date of amendment is 1st September, but in the amendment they mentioned that this is applicable from 1st April 2020. Income tax law does not recognize retrospective amendment. So what is the income tax law say? No question of retrospective amendment. Amendment can only be prospective. Amendment can only be prospective, cannot be retrospective. That is the first thing income tax law saying. Okay, you can amend. From September 1st, you can amend. So, if you have mentioned from 1st April, I am not recognizing that. I will only give the effect from 1st September. So, what will happen in this case is, interest on capital will be computed at 5% from April to August and 12% from September to March. This is how income tax law will serve. I'd say as per act this is. As per deed you can have anything. That is your wish. Because ultimately the law says either as per act or as per deed, whichever is less. So our income tax law says it will be computed only that whatever amendment you have made is only will have a prospective effect and not a retrospective effect. Okay, okay. A prospective amendment is only possible, not a retrospective. Good one. Okay, right. So remember this. And all these things are taxable in the hands of the partners under whatever is allowed. Only whatever is allowed is taxable under PGBP. Additional points to remember: no expenses can be claimed by the partners against such remuneration or interest except interest on loan taken for investment, that is only against otherwise no expenses. Remuneration is only payable to individual, whereas interest on capital can be even paid to companies. Because a company can be a partner in a firm, vice versa is not possible. Partner cannot be a member of the company. Okay, so companies, you can pay interest on capital. How will you pay company as a working partner, etc.? Remuneration paid to a director is covered under 48 too, but remuneration is paid by a partner is covered under 40B only. Okay, in PGBP also I left a question on that and said that while I'm doing assessment of firm, I will come to that. It is popularly known as Great City Manufacturing Case Law. Okay, okay, it is a firm and that firm paid remuneration as per 40B. What is remuneration as per 40B? Up to 3 lakhs 90%, more than 3 lakhs 60%, which is also approved by the deed. The assessing officer said this remuneration is in excess and disallowed under 40A subsection 2. Firm and the partner are related. So the assessing officer said the remuneration is paid is in excess and disallowed that. The court said when the law itself has given the restriction, when the law itself has given the restriction up to 3 lakhs 90%, more than 3 lakhs 60%, if the law gives a restriction, that becomes fair market value. Fair market value here you need not go out. For director you have to see, because director's remuneration, how much can be paid, is not given in the income tax law. So you need to definitely check what can be the maximum paid as per the fair market. Whereas for a firm, the limit is specified in the law itself. So when the limit is specified in the law, why you should not? That is the whole point. So by interpretation, I understand fair market value is only this much. Okay, and I also want the class to understand this. I also want the class to understand this point. one other important point. 12% per annum is the maximum interest on capital. What about loan? For that also 12% per annum. Sir, why sir? Because if you have 16% for loan, I'm just giving you an example. What will partners do? They will put 1 lakh as capital, 40 lakhs as loan. We have seen debt equity combo, if it is not correct, what will happen? Because interest is deductible before tax. So whether you bring it as in the capital or whether you bring it as loan, FMV can only be 12%. FMV can only be 12%. This is only for partners. For the relative of partners, normal fair market value, whatever is the normal fair market value. Interest on loan provided by spouse or provided by a partner in a representative capacity are not covered under 40B but under 40A2. So market rate of interest will prevail. A quick reading of 40B alone. A quick reading of 40B alone. Okay. So interest and remuneration has a specific provision in PGBP chapter. Let us work out and see also later. Okay, so coming back, proportionate depreciation and interest on capital, interest and remuneration are the two provisions which are covered specifically in PGBP chapter. Now I am taking you to capital gains, which has lot of provisions for firms and partners. First listen, then we will again read so that we are twice clear. First thing is conversion of a firm into company. Conversion of company into LLP will not be treated as transfer provided some conditions are satisfied. When I did capital gains, I told you that I will see the condition in when I go to assessment of firm. There I gave you all successions are not regarded as transfers provided some conditions are fulfilled. Those conditions we will see it here. That's what I have said. Then introduction of partner asset as capital contribution, book value will be treated, and dissolution of a firm. For dissolution of a firm, I have been telling you that there is a new section which is coming in from next year. So the possibility of 9B is coming in. So the possibility of question is remotest in November. So considering all these things, I am going into capital gain, this time with the conditions. Okay, so now you can understand it in a better manner here. Conversion of a firm into a company. Conversion of a firm into a company, the term firm means LLP also. Please listen. Whatever you have studied, amalgamation in the nature of merger. All the assets and liabilities of the firm should become the assets and liabilities of the company. Assets and liabilities can be taken over only at book value. Section 43 also says, in succession, I will take it only at the book values and proportionate depreciation will be given if it is during the course of the year. Generally itself, we all know in succession, we have this terminology which is nailed into our minds. The provisions will apply to the transferee entity as it would have applied to the transferor entity had there not been a succession event. Okay, so all assets and liabilities should be taken over at book value. Now comes the next condition. Even in merger, it is there 90% of share capital something. Here, all the partners should become shareholders. All the partners should become shareholders. Each one having one share. Together, they should own 51% of the voting power for a minimum period of 5 years. All the partners should become shareholders. The partners should together own 51% or more of the capital for a minimum period of 5 years. Okay? The partners should own 51% or of more of the capital for a minimum period of 5 years. If I remember in amalgamation, the nature of 90%. Okay, here it is 51%, 5 years. So otherwise it is the same. But this condition is vital. This condition is vital. Together owns 51% or more of the capital for a minimum period of 5 years. If these conditions are satisfied, sir, how do I know that in the first year itself they will own for 5 years? First, they give the exemption. If they violate the condition, exemption will be withdrawn. That is, in the year of violation, it will be taxable. So once more, conversion of a firm into a company will not be regarded as transfer. No capital gain, provided the following conditions are satisfied. All assets and liabilities taken over at book values, partners become shareholders and they together own 51% or more of the share capital, voting power of the company. Reverse. Company, unlimited company or a private limited company converted into LLP only. They cannot be converted into firm. They can be converted only into LLP. LLP law has the provision. Do the same. All assets and liabilities only at book value. All the shareholders should become partners. What is it? There you saw all partners becoming shareholders, together owning 51%. Here, all shareholders should become partners and their share of profit is in the same proportion in which they held the shares. Okay, their share of profit is in the same proportion in which they held the shares. Suppose Mr. A holds 5,000 shares. Mr. B holds 3,000 shares. Mr. C holds 2,000 shares. Okay, A, B, C should become partners, and PSR, profit sharing ratio, should be 5 is to 3 is to, sorry, 5 is to 3 is to 2. All shareholders should become, they are all shareholder. Mr. A held 5,000 shares. Mr. B held 3,000 shares. Mr. C held 2,000 shares. Now they convert into an LLP. All of them should become shareholders, and the PSR, profit sharing ratio, should be in proportion to the shares held. In proportion to the shares held. Okay, right? Fine. And they should also continue to hold it for 5 years. They should also continue to hold it for 5 years. This apart, the company, because from a limited liability, or it might become an unlimited liability, everything. So they want only small companies to convert into LLPs. They want only small companies to convert into LLPs. They say that the turnover of the company should not have exceeded 60 lakhs, and the net asset should not exceed 5 crores. Net asset should not exceed 5 crores. Shall we study? Conversion of unlimited company into private limited, or private limited company into LLP. Assets should be taken over at book values. All the members of the company, shareholders, members, should become the partners in LLP. They should share the profits in the same ratio in which they had the shareholding. They should continue for 5 years. Turnover, so only small entities can be converted. So I told you in capital gain, I will study it in the right place. Succession of a firm by a company, okay, or rather conversion of a firm into a company, and conversion of a company, be it an unlimited company or private limited company, into LLP. Almost the conditions are the same, except in the last case there are 2 other conditions. This is said in section 47. Then, introduction of asset by the partner. Introduction of asset by partner. Value recorded in the books will be taken as full value of consideration. Full value of consideration will be value recorded in the book, not fair market value, but only value recorded in the books. This is what I was saying, that there is a new section, but I will speak about this. Dissolution of a firm. A firm gets dissolved, okay? Assets are distributed to the partners. Company goes on liquidation. Assets distributed to the members, not taxable for the company, not taxable for the company. For the members, since they are surrendering shares, capital gain arises. What is the full value of consideration? Monetary consideration plus fair market value of any transfer minus deemed dividend, share of results. We saw in one of the question, Raghu or something like that, he had 10,000 shares. Out of the 60,000 shares, urban land transferred, etc. We saw monetary and non-monetary. At that time I told you, partition of HUF is not a transfer. Liquidation of a company is not a transfer for the entity. whereas dissolution of a firm is regarded as transfer. Dissolution of firm is regarded as transfer. Okay, sir. Fair market value on the date of distribution to the partners will be treated as full value of consideration. Fair market value on the date of distribution. So, if there is a dissolution in 1 year, distribution, because it will take time to distribute the asset, they will not be immediately distributed. If dissolution is in a year, distribution is in a different year. If dissolution is in 1 year, distribution is in another year, year of distribution only you are taxing. Year of distribution only is you are taxing. Where a firm is dissolved, assets are distributed to the partners, it is regarded as transfer. Okay. The provision is also applicable if assets are distributed even without dissolving. You should not use it as a loophole, so they have brought it. Fair market value on the date of distribution. Capital gain will arise in the year of distribution, not in the year of dissolution. This provision, as of now, don't worry. As of now, don't worry, because undergoing lot of change. Where partner subsequently sells, COA will be previous owner, that is firm, but it undergoes a lot of change. It undergoes a lot of change. 9B, where even stock in trade becomes taxable. Till now, only capital asset. So if stock is not a capital asset, no taxation, but from next year, they are even charging the on stock in trade. So please hold that back. So capital gains chapter has 4 different arenas for exclusively firms and LLPs. Conversion of firm into company, conversion of company into LLP, introduction of asset by partner, dissolution of firm. Salaries, house property, PGBP, capital gain, IFOS does not have any specific provision for partners. IFOS does not have any specific provision for partners or firm. Clubbing also not specific provision. Then comes set off. Carry forward and set off of losses, which has an important provision. Once you listen, then we will read it. Once you listen. If a firm is dissolved or, not even dissolved, sorry. If a firm is reconstituted, repeat, if a firm is reconstituted due to death or retirement of a partner. If a firm is reconstituted due to death or retirement of a partner, share of loss pertaining to the deceased or retiring partner cannot be carried forward by the firm. A, B, C, D are equal partners and the firm had a loss of 10 lakhs. Mr. D dies or Mr. D retires. Reconstitution due to death or retirement of a partner, share of loss pertaining to that partner, share of loss pertaining to that partner cannot be carried forward by the firm. One exception which comes from contract law period, where the legal hire is appointed for the same benefits in case of death, then you can carry forward. Okay, that is a standalone provision for firms. Where there is a change in the constitution of firm, not for admission, not change in profit sharing ratio, due to retirement or death of a partner, such portion of loss pertaining to the retiring or deceased partner cannot be carried forward by the firm. Other changes, this provision will not apply, only death or retirement. The provision is only for loss. Unabsorbed depreciation can still be carried forward in full. If there is a change due to death and the legal heir is appointed for the same benefits, then the firm can continue to carry forward the loss. If a firm is converted into a company and the firm has loss, can the company carry forward? Provided that conditions are satisfied. What condition? 51%, 5 years. Okay. Losses and unabsorbed depreciation can be carried forward by the company and set off. All the conditions in section 47 has to be fulfilled. Conversion of company into, however, if the company has a MAT credit, MAT is only for company. It cannot be set off against AMT. Vice versa also. AMT is only for non-corporate. It cannot be. The mode of computation itself is different. The mode of computation itself is very different. I hope the class is following. I am going headwise and making you chapter. As the chapter travels, let us travel and see whether what our firms are. Okay. So set off carry forward. Deductions has nothing specific to them. Okay. And then comes the transfer pricing regulation, special regulation, assessment procedures are all like any other normal thing. The next stopover is what happens to the special liability. What is special liability? My dear friends, the term special liability means where a firm dissolves but there are tax arrears. A firm has dissolved but there are tax arrears. Income tax department will just find one partner of the firm at the time of dissolution. There might be even 10 partners. Income tax department will find one partner and issue notice to him, pay the tax, pay the full tax. Partner's liability is joint and several. Partner's liability is joint and several. All the partners are jointly and severally liable for any tax due under this law. Where the firm is dissolved, then the partners in the year of dissolution are liable only for any dues under this law, even one partner, joint and several. Legal heir of the partner are also liable in the case of death, of course, to the extent of estate inheritance. TDS has no specific provision. I have to remind you that section 194 TDS provision, okay, interest is not applicable for interest on capital. So interest on capital tax need not be deducted, but if the partner is a non-resident partner, then 195 will be covered. 195 will be covered and not 194. Tax rates, base rate 30%, surcharge 12%, for income exceeding 1 crore, HEC 4%. All other normal special rates continue as it is. LTCG, STCG on which STT paid, winnings, etc. So these are all the cumulative provisions standalone for the firm. Otherwise, firm is PGBP. Otherwise, firm is PGBP. Can you quickly run through these pages, please? Can you quickly run through? Okay, okay. So please understand. These are all the various provisions set in various places in the law. Okay, 40B being the key aspect of partnership firm and also special liability. Conversions, you know now the condition of 5 years, 51%. The reverse conversion or from company to LLP, same ratio, okay, same 5 years and additional conditions. Okay, let us do some, let us also understand some case laws pertaining to partnership firm. First, Anil Hardwares. As I told you, this case law tells us that it is enough if there is a mere mention that remuneration will be paid as per 40B. There need not be quantification. Remuneration 10,000 per annum, 15,000. Should I specify this? No. All of us, what we do in practical circumstance, why should we have a conflict between deed and act? Okay, whatever is in the act, cut and paste it in the deed. Partnership deed does not specify the quantum, but just specify that remuneration will be paid as per 40B. AO disallowed the entire remuneration, specifying that the deal is silent, held by the High Court, that the quantum need not be a certain sum of money but can be based on limitation. Partners, in order to avoid conflict between deed and law, they can mention the restriction of 40B as it is and they can. Okay. This is a repeated case, M. Venkateshwara, many times, because it directly links with 269 ASS. Okay, what is it? The partner, understand the case. The partner introduces capital or gives loan to the firm. Assessing officer sent a notice to the firm saying how come they got the money. They said that we got it from the partners. What is the source for the partners? The firm is saying we don't know, and the partners are not giving the source. So the assessing officer says this is unexplained cash credit. So the assessing officer said this is unexplained cash credit and taxed it in the hands of the firm. Assessing officer said this is unexplained cash credit and taxed it in the hands of the firm. Is it correct? The answer is no. If at all it is unexplained cash credit, in whose hands it is taxable? In the hands of the partners, the individual, not in the hands of the firm. M. Venkateshwara. Partners introduced capital into the firm. The partners were unable to specify the source of investing that capital. How come they got it? AO proceeded again. This is the mistake AO did against the firm and taxed it as unexplained cash credit. Held by the High Court that any proceeding against such unexplained source can be only against the partners and not the firm. The firm has explained the source. They have said that I received it from partners. Only the partners have failed to give satisfactory explanation. Hence, the proceeding under section 68 can be, that is unexplained cash credit, can be made only against the partners and not against the firm. Not against the firm. In this case, they will say like this. In Muthoot Financiers case, we will see it when we are doing assessment procedures. They are going to say, partner and the firm are not two different persons. Partner and the firm are one and the same. They will give you an explanation. Remember, I will come to you and explain. But here, and this question has been twice already tested by our institute. Okay? The logic is simple. Whenever it is a assessee favorable judgment, the possibility of questioning by our institute is more. This is what I said, Great City Manufacturing Company, where I said, I have paid remuneration as per 40B. I have paid remuneration as per 40B. But the AWO disallows, saying that this is in excess of fair market value. Held by the court, when section 40B specifies the limitation, that becomes fair market value. AWO cannot have any other basis of computation. I told you, loss of a firm cannot be, on death or retirement, loss cannot be carried forward by the firm. Can loss suffered by a firm be carried forward and set off by the partner who took over the firm? Not possible. Loss can only be carried forward by the same person. Section 78(2), which deals with carry forward of loss in case of succession of business, provide that only that person who has suffered the loss or his legal representative has the right to carry forward the same. Therefore, loss of the firm cannot be carried forward by the company or by the individual. I'll come to AOP related later. Okay. Okay. Right. So this is firm. Apart from it, you know AMT provision, that is not just for firm, applicable for all non-corporate assessees. So with this knowledge, with this thing, we are going into practical approach. Let me start with question number 1. Manohar and Hari LLP is engaged in multiple business. The following information is furnished. Net profit 52 lakhs. Working partner's salary debited to P&L 40 lakh 20,000, which is authorized by the deed. Interest on capital paid at the rate of 15%, 15 lakh 75,000 specified in the deed. Depreciation debited, eligible depreciation. Net profit includes profit of an undertaking which is in the 4th year 20 lakhs. The total turnover being 200 lakhs, export turnover being 150 lakhs. 4th year means you can claim 100%. The unit has earned income from generation of power which is eligible for deduction under 80IA. You are required to compute the total income of the firm and also the AMT and decide the final tax liability of the firm. Net profit as per profit and loss account. Net profit as per profit and loss account 52 lakhs. Adjustments. Remuneration to partners. First we will add it back. Remuneration to partners 40 lakh 20,000. 40 lakh 20,000. Excess interest on capital allowed only till 12%. Okay, as per act. Even though deed says, even though deed says 15%, either as per act or as per deed, whichever is less. So they have paid, okay, 15%, 15 lakh 75,000. So 15 lakh 75,000 is 15%. What is 3%? Excess is 3%. This 3 is nothing but the excess. Okay, up to 12% only allowed. This 3% is excess. So 15 lakh 75,000 divided by 15 into 3, 3 lakh 15,000 is disallowed. Up to 12% allowed. Up to 12% allowed, over and above that disallowed. Over and above that disallowed. Okay. Depreciation debited to P&L 8 lakh 10,000. 8 lakh 10,000. Depreciation as per IT law. Depreciation as per IT law 10 lakh 35,000. Okay, then comes exemption and deduction. Book profit 93 lakh 10,000. 52 lakhs is the original profit. So, original profit. Add back the amount debited as remuneration. Add back the excess interest on capital. Add back the depreciation. Reduce the eligible depreciation. I hit that book profit. Maximum remuneration under section 40 subsection B. Maximum remuneration under section 40 subsection B as per deed. We all know they have paid it as per deed 40 lakh 20,000. Working partners the salary debited as per deed 40/20 as authorized by the deed. So as per deed 40/20. As per act, please understand 3 lakh into 90% plus 90 lakh 10,000 into 60%. Book profit is 93 lakh 10,000. Book profit is 93 lakh 10,000. For the first 3 lakh 90%, because that will be higher. Only if it is up to 160 or so, 150 might be higher. But here, okay, 3 lakhs into 90%. Okay, 3 lakhs into 90% plus on the balance. What is that? 93 lakh 10,000 minus 3 lakhs into 60%. Okay. 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 As per. So 90 lakh 10,000 into 60%. 3 lakhs into 90%, whichever is less, whichever is less is allowed. Whichever is less is allowed. Net profit after remuneration. Net profit after remuneration 52 lakh 90,000. Exemption under section 10AA. Exemption under section 10AA. It is in the 4th year. 20 lakhs is the total profit into export turnover by total turnover into 100% because we are in the 4th year. Up to 5 years it is so. Okay. 20 lakhs into export turnover is 150, total turnover is 200. Okay, into 100%. Repeating, 20 lakhs into 150 by 200. 100% is allowed because we are in the 4th year. Now I get gross total income. Now I get gross total income. Now I get gross total income. There are no other sources. This is gross total income. Deduction under section 80I, the question itself gives. As I told you, they will give you the quantum. Nowadays, they are not questioning you on computation because they know that these are sunset provisions. 8 lakhs. Total income. Computation of tax on total income. Pays tax at the rate of 30%. Add HEC at 4%. Total tax payable computation of adjusted total income 115 JC. Okay. Total income as per normal provisions. Total income as per normal provisions. You can also write total income after all deductions, expenditure and exemption, or just write total income. And exemption under section 10AA. Add exemption under section 10AA. Okay, 15 lakhs. Deduction under 80IA. 8 lakhs. There is no 35 AD. Okay, so adjusted total income. Alternative minimum tax at the rate of 18.5% of ATI and its HEC. Okay. Normal tax we all know is 930 to 880. AMT we all know is okay. A non-corporate entity is liable to pay either at normal rates or AMT, whichever is higher. So 1017,796, where AMT is paid, the difference between AMT and normal tax will be carried forward as tax credit. So what will be the tax credit? This minus this. This will be adjusted against, this will be adjusted against normal tax payable in the future years. Maximum period of carry forward 15 assessment years. Question number 2. For the financial year 2021, a firm declares a total income of 80 lakhs before allowing ATIA 49 lakhs. However, the accounts of the firm are yet to be completed in full. The firm is of the belief that they can file their income tax return after the due date, after ensuring all aspects of their accounts are proper. Advised by working out the tax liability and enumerate the various provisions. Okay, question number 2. If returns are filed, okay, if returns are filed after the due date, if returns are filed after the due date, okay, net profit before claiming ATIA is 80 lakhs. Deduction under section 80IA not available as the returns are not filed within due date. Okay, in the later part of our class, okay, I'm even going to tell you that this is a prima facie adjustment under 143(1)(a). Section 143(1)(a) says matters which does not have a dispute, mistake apparent on record can be rectified by the computer CPC wherever there is no dispute. One of the point is where due date, where you have filed the return after the due date but you have claimed the ATI, it will not be allowed because there is no dispute at all there. Not available if returns are not filed within due date. Okay, so you cannot claim total income 80 lakhs. Total income 80 lakhs. Okay, tax at the rate of 30% on such total income. Tax at the rate of 30% on such total income and HEC at the rate of 4%. Total tax if return is not filed within due date. Total tax if return is not filed within due date 24,96,000. Total tax if your total tax if return is not filed within due date 24,96,000. If returns are filed within due date, if returns are filed within due date, okay, what happens? Deduction under section 80IA would have been 49 lakhs. Total income 31 lakhs. Total income 31 lakhs. If returns are filed within due date, please wait, I'm not yet over. Okay. My normal income would have been 31 lakhs and my total income. Okay. I am taking an additional column without wasting time now. AMT. AMT. Okay. Or ATI, in fact. Adjust the total income. Okay. I take the normal income and add back this 49 lakhs, okay, total income slash ATI, okay, which will be plus, okay, which will be plus, okay, 80 lakhs. Tax at the rate of R, okay, or 18.5% of ATI. So this will be 18.5%, and these two will be continuing. Okay. Tax payable if return is filed within due date is 15 lakh 39,200. Tax credit to be carried forward. Tax credit to be carried forward is 1539,200 minus 967, 5,72,000. So please understand, if I don't file within due date, I am paying a tax of 24,96,000. If I don't file within due date, I am paying a tax of 24,96,000. If I file within due date, I am only paying 15,39,200. Out of that also, I get a carry forward benefit of 5,72,000 to be adjusted in the future years. Conclusion. Assessee should file the return within due date, and any rectification to the filed return can be made through revised return. Okay, so you file it before October 31st. After your accounts are over, they are teaching us this. Okay, we are masters of this. Okay, for us, only revised return date are more applicable. Anyhow, nothing deviation. Okay, so assessee should file the return within the due date, and any revision it can make and file it in that way. That is the conclusion. Examination question, whatever those two, everything is almost an examination question. So, before going out of AMT provisions and going to the normal provisions, other questions of the firm, okay, I want the class to be now very, very clear about something. When to work out AMT, when to work out AMT, three circumstances would warrant you to work out AMT. Three circumstances would warrant you to work out AMT. If you claim expenditure under 35 AD, specified business, if it should be a non-corporate, so 35 AD, exemption under 10 AA, deductions, income oriented, 80I onwards. Then work out AMT. One expenditure, one exemption, one type of deduction. Okay, reduce the depreciation on that. That is it. AMT has to be worked out. 18.5% is the rate, and the tax credit to be carried forward for 15 years. I am moving out of AMT with this question with the belief that it is nailed into your mind as to when to work out AMT. Okay, right? Fine. Question number 3. Any transfer of a capital asset or intangible asset by a private company or unlisted public limited company to a LLP, or any transfer of shares or shares held in a company by a shareholder on conversion of a company into LLP in accordance with 56 and 57 of the LLP Act shall not be regarded as transferred for the purpose of capital gain, subject to fulfillment of certain condition. Explain the provision. We all know it. We all know it. We have studied it. I'm not explain. I'm giving you the answer, not writing it. I'm giving you the answer, not writing it. All the assets and liabilities of the company should be taken over by the LLP, should become the assets and liabilities of LLP. Assets and liabilities should be taken over only at book values. All the shareholders of the company should become the partners of the LLP, and their share of profit should be in the same proportion in which they held the shares in the company. Repeating this again, all the shareholders of the company should become the partners of the LLP. Their profit sharing ratio should be in the same ratio in which they held the shares in the company. Turnover not to exceed 60 lakhs. Net asset not to exceed 5 crores. I'll write, refer page 281. Okay. Refer page 281 of the first draft material. That you have the answer. The partnership deed of a firm does not specify the remuneration payable to each working partner, but lays down the manner of fixing the remuneration as follows. In case of book profits of the firm up to rupees 3 lakhs, partners would be entitled to a remuneration of 1.50 or 90%, whichever is higher. On the balance book profit, it is 60% shall be computed in accordance with section 40B. In case there is a loss in the particular year, the partner shall not be entitled to any remuneration. Remuneration payable to working partners should be credited to the respective account at the time of closing of the accounting year, and the working partners shall be entitled for equal remuneration. Can the firm claim deduction in respect of remuneration paid to partners? The question is similar to the facts of the case of Anil Hardware. Okay, that is what we saw. Okay, should the remuneration be quantified, or can the limitation as per 40B be laid out? It is held by the High Court that in order to avoid conflict between law and deed, the firm can mention the limitation of the said provision in their deed. Okay? Quantification is not a sum of money but also the maximum payable. Hence, such specification will also be considered and remuneration can be paid to the partners. It need not be a certain sum of money. It can be just a limitation. Even the partnership firm can say 90% of profits, 75% of profits. Some limitation, let them say, or limitation of 40B in order to avoid a conflict between law and deed. I can just mention it. It is the judgment of Anil Hardware. Question number 5. X and Co., a partnership firm consisting of 3 partners, enhanced working partner salary from 25,000 to 50,000 per month for each partner. The increase was authorized by the deed of partnership. The AO during the course of assessment contended that the remuneration paid for each partner is in excess of is excessive and applied for relative payment within the statutory limit prescribed under 40B. Decide the correctness of the assessing officers. Okay. The question is similar to the facts of Great City Manufacturing Co. Okay. Okay. Maximum remuneration for partners is determined under section 40 subsection B. Maximum remuneration that can be paid to the partners is determined under 40 subsection B, where firm pays remuneration in accordance with 40B, then AO shall not disallow applying provisions of 40A subsection 2, payment to relatives. AO shall not disallow. Okay? In other words, limitations laid down in 40B shall be treated as fair market value. Limitations laid down under 40B will become fair market value, and AO shall not be disallowing any excess remuneration in applying the provisions. Okay, right? I take this opportunity to recollect one more thing. Though it is not part of question, I recollect that. Okay, right? Additional answer. You need not write it in examination. The question is answered. Additional answer. Where there is a amendment to the deed. They have said 25,000 remuneration is increased to 50,000. Such amendment shall be only having a prospective effect applicable from the date of amendment and not a retrospective effect. Please remember this. Any amendment under income tax law, it can only have a prospective effect and not a retrospective effect. Not a retrospective effect. Raja Kailash inherited as a co-owner plinth, which was offered to tax under income from house property. AO taxed the income under the same heading, but treating all co-owners as AOP. It is a AOP related question, so still I want to answer this. House property cannot tax vacant land or plinth areas. Plinth is land areas. House property cannot tax. House property means land and building opportunent thereto. There should be a land, over that there should be a building. Land and building opportunent thereto can only be taxed by house property. So plinth area, rent for plinth is taxable only under IFOS. Remember this, from here to individuals, I will often repeat this. If the shares are clearly known, they can only be taxable as individuals and not as AO. If the members' income are clearly known, they should be taxed only as AOP and not individuals. Sudhir Nagpal. Even you can take Govind Bhai Mamia, held by Supreme Court, that the income from asset inherited by the legal heirs is taxable in their individual hands, and you cannot give them the status of AOP when you know clearly this is their incomes. In this case, held by High Court, that the income from letting out of plinth is assessable under IFOS and not IHP. Subsequently, co-owners have inherited the property from their ancestor and there is nothing to show they are AOP. It is held that the rental income has to be assessed in the status of individual and not AOP. Consequently, this is AOP provision. Would not be attractive. Okay. Question number 6. The facts are similar to Sudhir Nagpal case. It is held that rent from plinth is taxable under IFOS and not IHP. For taxing under IHP, it should be land and building opportunent thereto. Okay, then only you can tax it under IHP and not. Okay, in this case it is taxable under IFOS. Further, in Sudhir Nagpal and Govind Bhai Mamaya case, it was held that mere inheritance or mere joint ownership does not mean that the income is taxable, treating them as a mere mute the, can you please mute the mic? Please mute the mic. Okay, mere okay, it was held that mere inheritance or mere joint ownership will not mean that the income is taxable, treating them as AOP. Okay, when the individual shares are clear and known, they are the income is taxable in the hands of such individual only. Shraddha Devi, can you please mute your mic? Please mute your mic. Question number 7. Partners introduced capital into the firm. The partners were unable to specify the source of investing such capital. AO proceeded against the firm and taxed it as unexplained cash credit. Okay. Okay. Question number 7. The facts are similar to Venkateswar. Okay. The facts are similar to Venkateswar case. Okay. Where the partners are unable to specify the source of earning such income, then AO shall only proceed against the partners and not the firm. Against the partners and not against the firm. Okay. When the partnership firm has said what is their source. Their source is from the partners. Only the partners are unable to explain. So AO can only proceed against the partners and not the firm. Can you please check one of you has not muted your mic when the recordings, when it is getting recorded and somebody is listening from recorded lecture, please. Shraddha Devi, can you please mute your mic?
అదే అంటున్నా సైడ్ కి 2 టైర్స్ కూడా డామేజ్ అయిపోతున్నాయి.
Can you please mute your mic?
కదా వాళ్ళగా కూర్చున్నాయి
Can you give me a minute? I will mute and come.
అంత డీటెయిల్ లేదా ఇంట్లో పోతున్నాయి.
Yes, friends. Now we walk towards some of the important questions. Okay, again these are examination questions only. Some brilliant questions with regard to partnership firm. Okay, question number 8. MNO Corporation LLP is carrying on two businesses. One is textile manufacture and another is operation of cold chain facility. This operation of cold chain facility is a specified business. It gives you the following information for the year ended 31st March 21. Net profit from textile manufacture from operation of cold chain facility. The following are debited to the pre-ended. Interest on capital to partners, working partners salary 1 lakh for 3 partners, depreciation on factory building, depreciation on plant and machinery for textile business, human insurance premium paid. Other information, eligible depreciation are 27 and 4 lakhs. The assessee set up a cold chain facility in 2019, incurring capital expenditure towards construction as under cost of land, cost of construction. The income for the financial year 1920 is income from textile business, income from cold chain facility, which is before deduction of 35 AD. I told you, you need not remember the businesses. Somewhere in the question, they will always give you that this is as a specified business. This comes under 35 AD. Somewhere they will give you, don't worry. The firm originally had 4 partners, and one of the partner retired us on 31/3/2020. The partnership agreement authorized payment of salary and interest which are debited to P&L. You are requested to compute the total income, ignoring the AMT provisions. Ignoring the AMT. Read through. Okay. Computation of income from specified business. Okay. For financial year 1920. I'm starting from there because they have given the information like that. The firm had in the previous year 1920 income from textile, income from cold chain facility, and they have said what is the cold chain facility expenses. So, 1st June 19 up to 31st March 20, they have given, before even coming to this current year, we need to do that as a working note. We will do it. Okay. Income before claiming 35 AD. Income before claiming 35 AD 60 lakhs. The expenditure under 35 AD, cost of land, we all know not allowed. Okay, we all know not allowed. Please write it in examination also and say it is not allowed. Cost of building and machinery. Cost of building and machinery 80 lakhs. Okay, 80 lakhs. Okay, loss from specified business to be carried forward and cannot be set off against textile business. We all know that this loss cannot be set off against the textile business, though textile business has an income in 1920 of 12 lakhs. This loss cannot be set off. This loss cannot be set off. It is loss of specified business and it can be set off only against income from specified business. It can be set off only against income from specified business. Fine. On 31st March 2020, one of the four partners retired. The firm had four equal partners and one retired on 31/3/2020. One of the four partners retired. According to section 78, where there is reconstitution of a firm due to retirement or death of a partner. According to section 78, where there is reconstitution of a firm, why? Due to death or retirement of a partner, share of loss of such partner cannot be carried forward by the firm. Share of loss of such partner cannot be carried forward by the firm. Hence, only three-fourths of the loss can be carried forward. Okay, only three-fourths of the loss can be carried forward, not the entire loss. Only 15 lakhs can be carried forward. Okay, only 15 lakhs can be carried forward, not the entire loss. This is one other important thing to understand, that is, what is the amount of loss to be carried forward cannot be entire 20 lakhs. We just saw in the case of reconstitution of a firm. What type of reconstitution? Due to death or retirement of a partner, only such portion of loss can be carried forward. Okay, that is, you cannot carry forward the loss of the other. So in this case, this is important to understand. That's why we started the answer from 1920. They have given it so. They have given the information so. Computation of income for FY 2021, that is AY 21-22. Net profit as per P&L account, 10 lakh 25 plus 20 lakh 50,000. 10 lakh 25,000 plus 20 lakh 50,000. 10 lakh 25,000 plus 20 lakh 50,000. Adjustments. Okay, interest, excess interest, okay, maximum allowed is 12% as per Act. So they have paid interest on capital for items debited to P&L. Interest on capital, they have put 15% on the total capital of 1 crore. I will disallow 3%. I will disallow 3%. Into 3% I am disallowing. 1 crore into 3% I am disallowing. Okay. Okay, 3 lakhs I am disallowing. Remuneration paid to partners. First I am disallowing remuneration paid to partners, 36 lakhs. Depreciation as per books. Depreciation as per books, 5 plus 35, 40 lakhs. Okay, 40 lakhs. Depreciation as per books. Okay, 5 lakhs plus 35 lakhs. Both are disallowed by me. Okay, 40 lakhs. Keyman insurance premium is allowed as a deduction. Okay, Keyman insurance is allowed. When they get the money back, it is taxable. Section 41. Any expenses, losses, deductions allowed earlier, now recovered, it will become taxable. So it is allowed, Keyman insurance. Okay, depreciation as per IT law. Okay, depreciation as per income tax law, 27 lakhs plus 4 lakhs. 27 lakhs plus 4 lakhs. Depreciation as per income tax law, 27 lakhs for machinery, 4 lakhs for building. So minus 31 lakhs. 21 plus 4, 31 lakhs. This is allowed. Okay, book profit. Book profit. Profit 78 lakh 75,000. Book profit, my dear friends, 78 lakh 75,000. Maximum permissible remuneration. Maximum permissible remuneration. As per deed, whatever has been paid, they themselves in the question has said that whatever you have debited, okay, right? The partnership agreement authorizes salary and interest which are debited to P&L. So, as per deed, it is 36 lakhs. As per Act, nothing but 3 lakhs into 90% plus 75 lakhs 75,000 into 60%. Nothing but 3 lakhs into 90% plus 78 lakhs 75,000 minus 3 lakhs into 60%. Okay, right? Whichever is less. Whichever is less is allowed. Okay, whichever is less is allowed. Taxable business income. Sorry. Yeah, taxable business income. Taxable business income, okay, 42 lakhs 75,000. 42 lakhs 75,000 taxable business income, 42 lakhs 75,000. Brought forward loss. Brought forward loss. Okay, okay, we all know we have revised the loss to be brought forward adjusted to 15 lakhs. Okay, then that gives me gross total income or total income. If there is no other deduction, gross total income or total income 27 lakh 75,000. 27 lakh 75,000. Okay, 27 lakh. You write down. I will give you one more explanation. For the doubt that you have asked, I'll come back. Okay, 27 lakh 75,000. Some of you might have said, is the loss can be adjusted only against specified business income? I am also okay, only adjusting against that. Working note for adjustment of loss, specified business income. You all know it is 20 lakh 25 50,000. We all know that the cold chain facility is 20 lakh 50,000. Even if all adjustments of interest and remuneration are made only in specified business. You need not make it, but I'm telling you, okay, even this 3 lakhs is added only to specified business. Okay, is added because that depreciation is textile business. 2050 plus 3 lakhs, 2350. Sufficient profit is there to adjust the loss. I'm repeating the point for you to understand. Remuneration, I have added and reduced the same amount. I have added 36 lakhs, reduced 36 lakhs. So net adjustment is nil. Even if the interest is added here, even if the interest is not added here, I want only 15 lakhs. I have sufficient profit to adjust. That's why I adjusted. That's why I adjusted it. Okay. One of our friends' question I want to answer. Sir, can you please say about the applicability of AMT? Yes, my dear friend, AMT is applicable in three circumstances. When you claim expenditure under 35 AD, for AMT computation, you need to add back and allow only the depreciation. When you claim exemption under 10 AA in the normal provision, in AMT, you need to add back. When you claim income-based deduction, especially 80I, in normal provision, you will allow it. In AMT, you will add it back, taking the total income. So, AMT is applicable. You need to work out AMT in the examination. You need to, unless the questions like this, ignore AMT. You need to work out AMT in three circumstances. If you are claiming 35 AD or 10 AA or 80s. ATI income based. We are progressing to some of the interesting questions again on a larger manner. Okay. One of our friends has said that can we have the section numbers for adjustments? Yes, wherever needed. Some are circulars, some are section numbers. I will definitely give you those wherever needed. Don't worry. A HIG, a firm consisting of three partners, H, I, and G, carried on the business of purchase and sale of television sets in wholesale and manufacture and sale of pens. So they are also in manufacturing. So whenever the word manufacture comes, we remember additional depreciation under a deed. H and G, H, I, and G were partners. The deed of partnership provided for payment of salary amounting to 1,25,000 to each H and G who were the working partner. A new deed was executed on 1st October 2020, which apart from payment of salary to the working partners as mentioned in the original deed, for the first time also paid for interest of 12% on the credit of capital account of the partner. So from 1st April 2020, from 1st October 2020, interest is payable, but they amended the deed with a retrospective effect from 1st April 2020. But we can have the prospective effect only. 40B says any amendment to the deed will only have a prospective impact. There is no question of retrospective impact. Only going forward you can amend it. Okay. Due to the differences between the partner, the firm was dissolved as on 31st March 2021, and the capital asset of the firms were distributed amongst the partner on 20th April 21. This is taxable only in the year of distribution, that is 21-22. I'll write all these things. As we read the problem, I am remembering these provisions. Dissolution of a firm and distribution of assets to partners, the capital gains section 45 says, is taxable only in the year in which it is distributed. The net profit of the firm after salary to working partners and debit or credit is as follows: 1,50,000. Interest amounting to 1 lakh paid to the partners on the balances of capital account for the whole year they have debited. For the whole year they have debited. Interest amounting to 50,000 on the balances of current account you cannot pay. The deed itself says it can only be paid to the capital account, to the credit of capital account. Balances standing to the credit of capital account. Current account you cannot pay. Interest amounting to 20,000 paid to HUF of a partner, 18% per annum. Payment of 25,000 towards television sets made by crossed check. 30,000 being the value of gold jewelry gifted from a manufacturer, being the value of gold jewelry received as a gift from a manufacturer for achieving sales target. Yes, it is a business income. Section 28 says all perquisites, whether converted into money or not, is business income. Depreciation of 15,000 on motor car purchased and used exclusively for business purpose but registered in the name of partner H, allowed. A. Sivakami and Co. A. Sivakami and Co. Beneficial owner can claim, I have funded, I am using, only the registration is in the name of partner, you can get it. Interest amounting to 25,000 from bank on fixed deposit made out of surplus fund IFOS. Interest amounting to 10,000 received from bank on fixed deposit which were made for providing bank guarantee K and Co. K and Co. It's a business income directly related. So these are debited or credited. When they give you debited or credited, these are considered. Additional information means might be debited, might be credited, or extra information like that. Okay. Additional information is for further adjustments, debited or credited. So always in an examination, look for what is debited or credited and also for additional information. The new machinery was purchased for pen division, which is the manufacturing division, on 11th November 20 for 5 lakhs. Depreciation is yet to be provided. For all other assets, it is provided as per IT law. On further analysis, you identified a similar machine was purchased in the last year for the same division, 7 lakhs. For the current year purchased machine, you will charge 7.5% normal depreciation. Depreciation is for the same is yet to be provided, both normal and additional. and the 10% additional because it is put to use for less than 180 days. Last year you had purchased the machine. It should be November 19, sorry. It should be November 19. Yeah, this should be November 2019. You understand a similar machine was purchased in November 2019, not November 20. This is only November 20. Please adjust it. This is November 19. For 7 lakhs. So last year you would have claimed only 10% for that. Claim that 10%. Closing stock was valued at 60,000 at cost. The net realizable value is 75,000. ICDS 2. In the case of dissolution of a firm, inventories has to be valued at NRV only. ICDS 2. Normally, if it is a going concern, cost or market price, whichever is less, in the case of dissolution of a firm, it should be valued at NRV only. Brought forward loss, fair market value of depreciable asset for distribution, compute the total income of the firm. Remember, 80% of the adjustment is from PGBP only. Only remuneration and interest is firm related. From PGBP only. So, only we are making our stronger knowledge on PGBP or capital gains, not anything else. Not anything else. Okay, right? Computation of total income of the firm. First, let me work out business or profession. Net profit as per P&L account. How much is that? Due to differences, the firm was dissolved. The net profit of the firm after payment of salary to the working partner is 1,50,000. Adjustments. Remuneration to working partners. Information is there on top. Deed of partnership provided for payment of salary of 1,25,000 each to H&G. So 1,25,000 into 2. 1,25,000 into 2 remuneration, which has been debited to P&L. Because the question says the net profit after paying the salary to partners, the following are debited and credited. Please understand. Interest on capital 1 lakh paid to partners on the balance standing to their credit account. Okay. The deed was amended only from 1st October 2020. So you cannot pay full year's interest. You can only pay half year's interest. According to section 40B of IT law, where a deed is amended during the course of the year, then the effect of such amendment can only be prospective and not retrospective. The amendments is applicable only from the date you are amending. You cannot have a retrospective amendment. In the given case, interest provision was included only from 1st October. Hence, interest on capital for 2021 is only for 6 months. Is only for 6 months. What they have paid is for the whole year 1 lakh. Okay, 1 lakh they have paid, divided by 2 will be disallowed. 1 lakh they have paid for 12 months. I will allow only for 6 months and disallow for 6 months. 50,000 disallowed. 50,000 disallowed. I will only avail for 6 months. I will only allow only for 6 months. Only for 6 months. Okay, 1 minute. Okay, only for 6 months. Okay, right. Interest on current account balance is not allowed. Interest is only for capital account balance, and the deed also provides the same. Normally on current account they will not give, only on capital account. If it is fluctuating method, then only the account name is capital account. Only if it is fixed capital account, you will have a capital account and a current account. Pay it only on capital account. If it is fluctuating method, only capital account. So on the opening balance you will pay it. Interest amounting to 20,000 paid to HUF of partner H. Okay, it is not paid to the partner. If it is paid to the partner, it will be covered under 40B. If it is paid to the partner, it will be covered under 40B. It is paid to a HUF in which the partner is also a member. It is paid to a HUF in which the partner is also a member. This comes under 40A subsection 2, payment to relatives. All our examination question will repeatedly ask on 3 or 4 provisions for sure. 40A2, payment to relative. 40A3, payment in excess of 10,000 on a single day to a particular person to unapproved mode. TDS default, depreciation, these are only repeated. If you think that 1 or 2 adjustment they might go, like closing stock we saw, that might be an extraneous adjustment, but otherwise the questions are all repeated on the same adjustment only. I can work out 25 questions also and show you that it is the same. So coming back here, okay, according to section 40A subsection 2, any payment to relative should be in line with FMB, where payment is in excess of FMB, such excess shall be disallowed. This is the base provision. Such excess shall be disallowed. In the given case, payment made to HUF where a partner is member is covered in 40A subsection 2. It is assumed, unless they give you the market value, don't disallow. It's assumed the payment is within FMB. So don't disallow, but write a note. Every adjustment, state the obvious. State the obvious. Write the note saying why you are allowing, why you are disallowing. Communicate to the examiner, I know what you are asking, and communicate the provision also. Okay, payment of 25,000 according to section 40A subsection 3. Any payment in excess of rupees 10,000 on a single day to a particular person through unapproved modes, the whole of the amount is disallowed. Unapproved modes are cash, bearer check, cross check. Cash, bearer check, cross the check. In this case, entire 25,000 is disallowed. 30,000 value of gold jewelry received from the manufacturer Fortune. It is already taken as income. No adjustment, but we should write why it is a business income. According to section 28, acquisite received by a acquisite received by an assessee shall be treated as business income, whether convertible into money or not. So in this case, it is interrelated to business and they have treated it as income, no adjustment. No adjustment needs to be made. Okay. Depreciation amounting to 15,000 on motor car purchased and used exclusively for business purpose, registered in the name of in A. Sivakami and Co. case, it was held that beneficial owner can claim depreciation. Asset is funded by firm, used by firm, registration is just a formality, substance over form. Any words you can write. I'm not saying write this exact words. If you don't remember the case law, you can still write beneficial owner can claim. Asset is funded by the person, used substance over form. Registration is just a formality. The firm can claim, so nothing to disallow. Nothing to disallow. Interest amounting to 25,000. Interest on surplus fund taxable under IFOS. Okay, 25,000. Taxable under IFOS 25,000. In K and Co case, it was held that interest on margin money kept deposited with bank is directly linked with business, hence to be treated as business income. To be treated as business income, so no adjustment. They have credited it. They have credited it, no adjustment. They have properly credited it, so we need not adjust it. We need not adjust it. Okay. First I will do closing stock, then come to depreciation. Okay. increase in the value of closing stock. Okay, according to ICDS 2, where a firm is dissolved, inventory has to be valued only on NRV basis. Only on NRV. So the net realized, you are valued at cost, the net realizable value is okay. ICDS has said that if it is a going concern, cost or market value, whichever is less. If it is a going concern, cost or market value, whichever is less. If it is a concern that goes out of existence, then yes, allowable depreciation for machinery purchased and used in manufacturing. Normal depreciation at 7.5%. Normal depreciation at 7.5%. 5 lakhs into 7.5%. Additional depreciation at 10% used for less than 180 days. Above also the same. Above also the same, used for less than 180 days because it's November purchase. So 5 lakh into 10%. Additional depreciation at 10% for asset purchased and put to use for less than 180 days in the preceding year. For you, this is kindly change the date as November 19. Okay. So this 7 lakhs for which I have to do 10%. 7 lakhs into 10%. So this is my depreciation. This is my depreciation 157 500. Brought forward loss. Brought forward loss. Okay. The brought forward business loss for 2021 is 50,000. Henceforth, you cannot go forward, but last years you can. Okay. Net business income. Net business income is 307 500. Net business income is 307 500. Net business income 307 500. Other sources. No, sorry, friends. I made a mistake. Sorry. This is later only. This is book profit. Sorry, friends. This is book profit 3,57,500. This is book profit 3,57,500. Maximum remuneration under 40B. Maximum remuneration under 40B. As per deed, Okay, 1,25,000 into 2 partners. Okay, remuneration is provision is there in the deed for long time. Only this provision is new. Okay, as per Act, 3 lakh into 90% plus 57,500 into 60%. Okay, okay. Repeating, 3 lakh into 90% plus this minus 3 lakhs into 60%. Whichever is less, okay, whichever is less, so 250. Now it is business income. Now it is business income less brought forward loss 50,000 net business income. Not that any of the adjustment is new to you. Probably inventory you might have forgotten, or you might maximum one mistake you will do, maximum two, but the question will be lengthy only because our institute font size is so, line spacing is so, so the question in the question paper might run even for 2-3 pages. That should not affect your morality, that should not affect your confidence. You should, every provision, if you read it you will remember that. If you read it everything together, you will only get the fear. Read the question once fully and then go to every provision, you will adjust. Okay, 8 adjustment plus 8 main adjustment plus 2 or 3 subsidiary adjustment, 11 plus some working notes. So totally out of 12, you might miss 2. Worst case scenario, I am very confident you will not miss. But worst case scenario, you may, just because you don't know 2, the rest the 10 confidence should not affect the 2. Vice versa cannot happen. My not so confident 2 should not affect my confident 10. It should be reversed. My confident 10 will make me answer the other 2 also. Okay? Hit it. Go and hit it. You will be correct. Okay? What are all the notes to write? Notes. Distribution of asset to partners on dissolution of a firm is taxable in the hands of the firm under capital gains only in the year of distribution. It is taxable only in the year of distribution. So, distribution of assets on dissolution of firm is taxable only in the year of distribution, not in other years. Remember this. This is note 1. So, okay, I will continue and write it also. So, the capital gain in the given question, it is distributed in April 21. Hence, capital gain will arise only in 21-22. This is one note. Okay. This is note number 1, note number 2. Okay, this is additional note. If possible, please write for the asset. Okay, you this note will not come. Okay, only one note. I thought the 10%, any of the firm is dissolved. Next year you cannot claim that 10%. Sorry. If the firm is a running firm, then you should write for this whatever you have claimed 50% in the current year. No, the balance to 10% can be claimed in the next year. In this case, firm is dissolved, so that doesn't arise. Please read through the answer. Look through the answer. Okay, okay. Every adjustment is only PGBP. Almost all questions will have the same adjustment. Never lose your confidence. Majority of the time, it is not lack of preparation. It is lack of confidence that makes us fear. My entire purpose here is to make you confident and to go and face it. You will, when you face it, you will win it. Quitters are not winners. When you go and face it, you will win it. You go and take the pen and start the adjustment. By God's grace, somewhere into your mind, whatever we discuss in the classroom will be stored. 80% of the papers you can answer with that confidence. Question number 10. A private limited company is converted into LLP from 1st April 2020. The following are the details: unabsorbed depreciation, business loss, unadjusted MAT credit, opening WDV of the assets, plant and machinery, building, furniture, cost of land acquired during the year 2000, VRS expenditure incurred by the company in 1718. Assuming all conditions relevant are fulfilled, explain the tax treatment in the hands of the LLP for each of the items. For each of the items. Tax treatment in the hands of LLP. Tax treatment in the hands of LLP. Unabsorbed depreciation. First one they are asking us is unabsorbed depreciation. Can be carried forward and set off by the LLP. Can be carried forward and set off by the LLP. Business loss brought forward. Business loss brought forward. Okay, can be carried forward and set off over the balance period. Totally 8 years. Totally 8 years. Suppose in the question they have given business loss of 15-16. You count and see. Okay, 16-17, 17-18, 18-19, 19-20, 20-21 financial year. Okay, or 4 years has lapsed. Over the balance 4 years, the LLP can carry forward. Like that. If they just give you business loss, can be carried forward over the balance period. Over the balance period. Unadjusted MAT credit cannot be carried forward. Unadjusted MAT credit cannot be carried. Mode of computation itself is different. MAT and AMT are not the same method. MAT is a format. AMT is a small thing. Okay, so cannot be carried forward. It is lost, permanently lost. Okay, the firm cannot be carried forward. LLP cannot. Depreciable asset, depreciable assets. Okay, according to section 43. Okay, in case of succession, assets shall be taken over at book values, value prevailing in the books. Okay, all depreciable assets will be taken over at WDV. Okay, what are all they? Plant and machinery, building, furniture. Okay, I'm writing some additional answers which will be useful for you. Okay, since the conversion happened on 1st April, the whole of depreciation can be claimed by LLP. We all know, since the conversion has happened here, the question they said on 1st April 2020 itself it has happened. Suppose if the conversion has taken place during the year, then depreciation will be computed ignoring the event, and such computed depreciation will be proportionately distributed based on effective usage period. Okay, such converted depreciation, such computed depreciation will be proportionately distributed based on effective usage period. Based on effective usage period. Great, good going, fantastic, fantastic. Okay, if you can answer like this, you will be able to hit at it in a good manner. Okay, non-depreciable asset, that is land. Okay, will be recorded at original cost. Okay, evaluation, if it is there, to be ignored. BRS expenditure of 1718, 50 lakhs. Okay, okay, according to section 35 DD, DDA, sorry, according to section expenses DD amalgamation DDA, according to section 35 DDA, VRS expenditure is allowed in 5 equal installments. So the company would have claimed for 1718, 1819 and 1920. So company would have claimed for 3 years. 30 lakhs would have been claimed by 50 lakhs. Each year 10 lakhs you can claim. Company would have claimed for 3 years. Okay, I am writing the general provision again. Okay, in the case of succession, provisions will apply to transferee entity as it would have applied to transferor had the event not happened. Okay, balance VRS expenditure, how much it will be? 20 lakhs will be carried forward by LLP and claimed in 2 years. That is 2021 and 21-22. So each year the LLP can now claim 10 lakhs every year. The LLP can now claim 10 lakhs every year. Okay, okay. Interesting question. Question number 11. On 1/4/2020, Binu Limited, a Delhi-based domestic company engaged in the business of manufacturing, converted into LLP by name Messrs. Soumya LLP, fulfilling all the conditions. Some of the relevant information is given below. VRS expenditure incurred in 18-19 20 lakhs. The company was allowed 4 lakhs for 18-19 19-20. So from this year, LLP will claim. 150 equity shares in Toyo Limited, an Indian company listed in Bombay Stock Exchange, was acquired for 1900 per share. On conversion, these became the shares of the LLP. Besides other asset transferred, to Mrs. Soumya LLP by Bino, it also transferred 2 factory buildings. On 1/4/2020, Soumya LLP leased out 1 factory building along with plant, machinery and furniture at a consolidated lease rent of 50,000 per month. Composite lease is taxable under IFOS. Lease of plant and machinery, equipment, etc. That is not my main business. So one of the factory is leased out for 50,000 per month. It is taxable in IFOS. It is taxable in IFOS. All direct expenditure can be claimed. All direct expenditure can be claimed. Okay, there is no restriction. All direct expenditure can be claimed. 1 minute. I will quickly underline that provision for you so that you are aware that we did it. Okay, okay. Composite rent, that is letting out of building, plant, machinery, equipment, it is allowed. All direct expenses including depreciation is allowed, and this is under IFOS. This is under IFOS. Good. Okay. During the financial year 2021, Soumya LLP earned a net profit after debiting or crediting the following. Binu is the working partner. He is also a working partner in another firm. Let him be. He is actively engaged in both the firms. So he is a working partner. Binu gets 55,000 salary authorized by the deed. Add back after computing book profit letter. The wordings, he is also working partner in another firm. Ayyo, is there any provision? Don't even think so. No. Is he a working partner? Yes, he is eligible for salary. He can be a working partner in any number of firms. Ayushman, an employee, was deputed to work in client office in Mumbai for 3 months. His salary 40,000 per month. He was paid in cash for the months he was in Mumbai. Since he did not have a bank account, employee temporarily posted outside the base location 40A3. It is allowed. Rule 6DD. Look at the wordings. They themselves will say it is allowed. An employee who is deputed in client office for 3 months, he is paid salary in cash which he was in Mumbai amounting, since he did not have a bank account there. The payment was included in salary debited to P&L. Mr. Aishman is normally posted in Delhi, that being the head office. So they themselves has given you the hint that look, he is temporarily posted outside. 25,000 was paid for penalty for non-fulfillment of delivery conditions of a contract. Penalty for violation of law is only disallowed. This is just among two persons. It is like compensation. Okay, allowed. LLP has provided an amount of 18 lakhs, being the sum estimated as payable to workers on the basis of an agreement entered with the work unit towards periodical wage revision. The provision is based on fair estimation and reasonable certainty. ICDS 10. ICDS 10. If the provision is based upon past experience and on a fair valuation, scientific basis, it is allowed. Depreciation debited to P&L, gratuity provision which will be disallowed and actual gratuity paid will be allowed. Profit on sale of shares of Toyo Limited. These shares were sold for 2,750. The highest price quoted on 31 on 18 is 2,200. Okay, capital gains 112A listed shares. Repairs to plant and machinery include 59,000 in respect of lease. That is IFOS expenditure. We will claim it in IFOS. Factory license fee 15,000 for each factory. So for the IFOS factory, I will add it out in my business income and reduce it in IFOS. Sir, what if I don't disallow? Anyhow, the answer will be the same. Book profit will be different. Remuneration will be different, so better too. And answering style also. Legal fees 26,000 paid to an advocate for leasing arrangement. Okay, up to this 10 adjustments, which is wholly for the profit debited or credited. Additional information. Under an agreement of debt restructuring, bank has converted unpaid interest amounting up to into a new loan repayable in 3 equal installments. The first installment was paid. I'll come back to that. I think one more adjustment, I will not have the number. I will come back to that. Mr. Binu, being a working partner, bought a car which is registered in his own name but out of the funds of LLP. The car was used for the purpose of business of the LLP. The depreciation on the car amounted to 15,000, which is not included in the depreciation. We need to include Sivakami and Co. Well, beneficial owner. Depreciation as per IT law 8,10,000, including depreciation on assets given on lease, which is 19,000. Does not include car. I will include. The LLP sold import entitlement 150. The sum is not treated as capital reserve. No, it is a business income. It is a business income. You are required to discuss the tax implication and compute the total income. By this, we will become more clear. You can understand 90% of the adjustment PGBP and capital gains are related only. Read through. One minute. Friends, this alone Under an agreement of debt restructuring, the bank has converted unpaid interest amounting to rupees 3 lakhs. Amounting to rupees 3 lakhs, friends. Okay. Okay. And here it should be March 21, my dear friends. 2021. Sorry for small mistakes. March 2021. One installment was paid before March 2021. 3 lakhs. While writing the answer, I'll also do it. Okay. Okay. Feel confident. You will be able to understand each and everything. Length of the question should not threaten you. Okay. Even in companies, I will prove you length of the question should not threaten you. Your confidence is superior. Okay. Computation of business income of Soumya LLP for FY 2021, that is assessment year 21-22. Okay, okay. Let's understand first business income, then capital gains, then IFOS, then we'll do the total income. You should be very thorough at the end of this question. That is my belief. Net profit as per profit and loss account. Net profit as per profit and loss account. During the mess, I earned a profit. This is what is missing. I will check the solution material where I have given the profit. Profit is 12 lakhs. Okay, 12 lakhs. I remember two things were missing in this. During the years, earned a profit of 12 lakhs. My dear friends, 12 lakhs here. Okay, okay, uh, okay. Net profit as per profit and loss account 12 lakhs. Okay, missing in the question as 12 lakhs. Adjustments, adjustments. Okay, let's go one by one. Okay, remuneration to partner 55,000 into 12. Okay, per month 55,000, 55,000 into 12. 55,000 per month, so 55,000 to 12. 40A3 normally disallows payment in excess of rupees 10,000 on a single day to a person. However, exception under Rule 6DD, if an employee is temporarily posted outside base location, then it will not be disallowed. In the given case, Aushman normally works in Delhi, temporarily posted in Mumbai. So nothing is disallowed. Nothing is disallowed. Okay. If you read the adjustment, they themselves will lead you to the answer also. Okay. Amount of 25,000 paid towards penalty. Don't stop here, then your answer might have gone wrong. For non-fulfillment of delivery conditions of a contract. Okay. Penalty for violation of law is disallowed under section 37. However, this is not law, it is violation of contract between two parties. It takes the character of compensation, hence allowed. There is nothing to disallow here. It is only debited days. What is known as compensation, not a penalty. It doesn't take the character of penalty. Okay. LLP has paid an amount of 18 lakhs. LLP has paid an amount of 18 lakhs towards workers' wage union settlement. Okay. According to ICDS 10, any provision which is based on past experience, computed on a scientific basis, will not be treated as contingent provision. Hence, wage revision based on experience is allowed. Okay, any provision on the basis of past experience, okay, will not be treated, so it should be allowed. Let's take depreciation as 10 lakhs. Very sorry for missing out some information. I have written it because you are not getting confused when you refer the answer. The interest of the question makes me to miss out some information while typing, but I am still sorry for that. Okay. Provision for gratuity is allowed under 40A subsection 7. How much? 6,50,000. Actual
Sir,
gratuity.
your not visible.
I'm not visible. Huh? Voice not audible. Video passed.
It is visible sir, now. Thank you.
Are you able to hear it out? Is the video clear? Yeah, Anju.
There was
Y-
actually
y-
not able to see for
uh, I'm unable to. Can you text it, please? Actual gratuity paid 4 lakhs. Again, the screen is hung up. It is struck. Just wait a minute. Just wait a minute. So, provision for gratuity is disallowed, but whereas the actual gratuity paid, okay, gratuity actually paid, they will adjust it with the provision. But since we are disallowing the provision, it should be allowed. Now, they have debited, credited profit on sale of shares of Toyo Limited. Sold for 2750. We know what price it is purchased for. We know it has been purchased for 1900. Okay, it is sold 150 equity shares. The profit has been credited. It has been purchased for 1950, sold for 2750. Okay, profit on sale of equity shares taxable under capital gains. Okay, sale price of 150 shares. We all know 150 into 2750. Okay, 2750. Okay, purchase price of 150 shares. Okay, 150 into 1950. So the profit that they have considered is this minus this. Okay, this we should tax it in LTCG. I'll come to that. At that time I'll tell you how to. So 1,20,000 profit on sale of equity shares. Okay, lease rent received. We all know 50,000 into 12. That should not be business income. This is taxable in IFOS, not a business income. And the related expenditures should be added up. The related expenditure should be added up. Okay, repairs for lease mission. Repairs for lease mission 59,000. License fee for lease land 15,000. Remember 15,000 each. 15,000 each. Okay, something. So can you give me 1 minute to write down the notes which was done during the scene start? Screen was stuck against. Yes, sir. Yes, sir. Sorry, you can take down. Is the screen visible? Stuck and audio is not there. Margaret, is it now visible, Margaret? Yeah, JK. Margaret, is the screen visible or still there is a stuck you see? Rizwan Aside, can you tell me whether you are able to see the screen now? It's visible for me. Okay, Jaika said it's visible. Anybody else? Rizwana or Margaret, can you just confirm me? Can you just confirm me? Yeah. Okay. Thank you. Yeah. So so many of us using one network. I don't know how to adjust this network issue. If I go elsewhere and face a new problem, I'm unable to. I in fact thought I will go elsewhere and take the classes, but if there are new problem, at least here I know who to contact immediately. Okay, so that's why, and I'm very illiterate also with regard to technology, so kindly bear with me, but keep communicating to me. And it is very difficult to see the communication from there. Take your time, please text me. Okay, right. License fees. Okay. Legal fees for drafting lease agreement. Okay, legal fees for drafting lease agreement 26,000. 20. So these are, this will be IFOS income. These are IFOS expenditure. These are IFOS expenditure. Wait, we'll see. Okay. According to section 43B, okay, interest not paid within due date will be disallowed as it is statutory payment and allowed in the year in which it is actually paid. In the given case, this would have been disallowed already and one installment paid now. So what happens? This 3 lakhs divided by 3. Okay, 3 lakhs divided by 3. This 1 lakh should be allowed now. According to 43B, interest should have been paid before the due date. Where it is not paid, it is disallowed because it is a statutory payment and allowed in the year in which it is actually paid. So in this case, it should have been disallowed. Can license fee be reduced from rental income generated from lease? Yes, sir. Yes, sir. I will work out IFOS separately, Rishabh. I will work out IFOS separately. Yes, it can be reduced. Okay, right. Okay. According to A. Sivakami and Co. According to A. Sivakami and Co. Beneficial owner can claim depreciation. Okay. So Binu can claim depreciation. I'm not liking the lengthy answer. Just one I just now I wrote. So depreciation 8,10,000 plus 15,000 for car minus, okay, leased asset depreciation 90,000. You can claim it in IFOS. 8,10,000 plus 15,000 for car minus leased asset minus leased asset depreciation. So 8,10,000 minus 90,000 plus 15,000. Okay. 7,35,000. 7,35,000. 7,35,000 is the depreciation. Is the depreciation. Okay. According to section 28, sale of import entitlement license is a export incentive taxable as business income. Is an export incentive taxable as business income. So you should consider it as business or profession. Okay, sale of import entitlement license is an export benefit taxable as business income. All these things are PGBP only. We are redoing PGBP only. Nothing of firm I did. I am only doing PGBP. That's why I said I will not end with PGBP there. I will continue. Okay. DRS compensation incurred 20 lakhs. The company has claimed 4 lakhs, okay, for 2 years, okay. DRS expenditure, 2 installments claimed by company, the balance 3 installments to be claimed by the LLP, 35 DDA. So how much is that? DRS 20 lakhs, okay, divided by 5, 4 lakhs. So I'm hitting at book profit now. I'm hitting at book profit now. ₹14,05,000. From the top, once I will come because some of you got a video stuck, etc. 12 lakhs I have, that is missing, so I have taken it. Please take it as 12 lakh. Remuneration, add back. Employee posted on a temporary location outside the base location, no disallowance, you can pay by cash. Age revision is based upon the past experience. ICDS 10 says it should be allowed. So allow it. Compensation is allowed. Just because the word penalty is used, don't get worried. Penalty for violation of law only disallowed. Depreciation as per books disallowed. Gratuity provision disallowed. Actual paid allowed. Profit on sale of shares disallowed because it is taxable in capital gains. Lease rent disallowed because it is taxable in IFOS. All expenses pertaining to that disallowed. Interest paid, allow it because in this year it is allowed. And depreciation as per IT Act, allow it. Import entitlement license is a business income. VRS compensation also should be allowed. VRS compensation also should be allowed. So I get a book profit of 14,05,000. Maximum permissible remuneration. Maximum permissible remuneration as per deed. As per deed, 55,000 into 12. That is for that one partner, we paid 55,000 into 12. As per Act, 3 lakhs into 90% plus 11 lakh 5,000 into 60%. Okay, 3 lakh into 90% plus 14 lakh 5,000 minus 3 lakhs into 60%. Okay, whichever is less is allowed. Whichever is less is allowed. So I get a business income. I get a business income of 7,45,000. I get a business income of 7,45,000. Hold it. Hold it. The question has a lot of understanding for us. Computation of capital gains. Section 112A. First, I will write a small note. In case of succession, cost of previous owner will be considered as cost of acquisition. We all know that. Okay, right? In case of listed shares, no indexation, under 112A. So in this case, okay, full value of consideration, we all know that he sold the 150 shares. He sold the 150 shares, okay, for 2750 per shares. 150 into 2750, 150 into 2750. This is my full value of consideration. Less cost of acquisition, okay. Shares are purchased after 31/1/18 because you can see shares are purchased on 31/7/18. Okay, so FMV on 31/1/18 to be ignored. Okay, if they have given shares or purchase before 31/1/18, then you will take a full value of consideration or FMV step 1, whichever is less, that along with actual cost, whichever is more. But here shares are purchased only after 31/1/18, so ignore the FMV. Okay, 1900. Gross LTCG under 112A. I hope it is LTCG. 31/7/2018, and I sold it on 2020 only. So more than 1 year LTCG. 1,27,500. Exemption under 1038 is you will not tax the 1 lakh. Okay, balance taxable at 10%. That is the sanctity. That is why I am not giving you the benefit of indexation, because that you are paying STT and the tax rate is only 10%. So I will not give you the benefit of STT. Lease rent received 50,000 into 12, 50,000 into 12, 6 lakhs, less direct expenses, on earning the lease rent. Okay, we saw here repairs 59,000, license fees 15,000, license fees 15,000. Okay, drafting fees 26,000, depreciation on leased asset 90,000, total under IFOS, 4,10,000. So you know to compute total income, business income is there, LTCG is there, IFOS is there. They have not asked for the tax. They have not asked for the tax. If at all they have asked IFOS and business income 30%. This is LTCG is only 10%. They have not asked for the tax. So you can work out the total. 1 minute, I think what. Okay. Okay. What I have worked is only business or profession. Capital gains, IFOS, very one or two provisions only firm related or conversion of firm into LLP into company, something like that. Very rarely we worked. That is all extra. Otherwise, we are becoming stronger in PGBP and capital gains as a whole. Okay. Especially this question, work out separately once at your house, okay, so that you will understand lot of PGBP provisions, conversions, etc. If you work out these 5 questions, 5 or 6 questions in firm, because all question has remuneration, majority of the question has interest, all the special provisions are also covered, so that you will be very confident in working out the firm question also if at all asked for. And on the test process, trust me, you are going to travel not just till August 31st. You are going to travel till your date of examination with me. Test is an inherent thing, including the MCQ. I know how to, I am trying to test it. Don't worry. I am making my effort for that also. Some of you have told me MCQs, can you help us? Yes, I will help you. Your travel is not over with August 31st. Our travel is going to be till your examination. Without affecting your other subject preparation, I know how to, I'm trying to, I know, I'm not saying I know means not with weight and all. I'm trying to ensure that you prepare DT always, you have a small time for DT in a day and work out. Okay, so don't worry. Your test process is also taken care. Your MCQs are also taken care by me. Right? Okay. With this, we end the firm and go to the next, which is popularly known as pass-through entity. I am going to a new sort of entity known as pass-through entities. Okay. What is it? Let me give you a small idea about what I mean by pass-through. You and me are unit holders. You and me are unit holders. We invest in an entity which will invest on behalf of us. So in between is this trust. They call it as a business trust, securitization trust, investment trust. It is in between. You and me will invest in this. This in turn invest on various other things. Whatever they get, they will pass it to us. So the in-between entity is a transparent pass-through entity. It gets money from individually. If we invest, we will not be a big investor. But collectively, how to invest, these entities do. So in between is this prism. It goes into and invest, come back, and it is given back to us, pass through. Pass through entities. There are 3 things: Securitization Trust, which is what is involved in restructuring of debts. Sarfazi law. Okay. Non-performing asset debt restructuring by RBI. Okay. So I invest in that. They go and get all the non-performing asset. They will ensure, they'll tell the banks, we know how to collect and give you. They collect or they seize the asset, sell it and give to the bank. They take some commission, they give us money. Investment trust or investment fund, which is registered with the SEBI, alternative investment fund. And the third most important is business trust, which is a real estate investment trust and investment trust, where the amendment has also happened and there is a questionable, there is a point or there is a possibility of a question. I wish I again tell you that please look into the amendment lecture for a detailed discussion on the amendment. I will again try to do it. Repeat. What is a pass-through entity? Securitization trust, business trust, investment fund. What are all the features? Majority of the income of these trusts are taxed in the hands of the unit holder, ultimate beneficiary. I get the income and give the income to you. If suppose I am the pass-through entity, you all, Riyas, Preeti, okay, Rishabh, all of you invest. I go and invest in some other fund. I get the income, give it to you. I am just a agent. The beneficiary of the income is you. Majority of the income of these pass-through entities are taxed in the hands of the ultimate beneficiary. That is unit holder. Okay, okay. All general theory here. Trust earned. Capital gains 5 lakhs. Interest 3 lakhs. Dividend 2 lakhs. So totally the trust earned 10 lakhs. Rishabh, a unit holder, okay, got 70,000 or let's take 2 lakhs from trust. In the hands of Rishabh, we say that this 2 lakhs is taxable. Taxable as what? Capital gain, interest, dividend, in what way? Okay, sir, you said in the first point. Taxable in the hands of the ultimate beneficiary. The ultimate beneficiary is the unit holder. In our given case, the ultimate beneficiary is Rishabh. Okay, sir, taxable in the hands of Rishabh. Under what head, sir? Salary, it's not salary. Under what head will I tax this for Rishabh? It will be taxable in the hands of the Rishabh in the same manner and in the same proportion in which the trust earned the income. This 2 lakhs will be bifurcated in the ratio of, this 2 lakhs will be divided in the ratio of 5:3:2. 1 lakh will be capital gains, 60,000 will be interest, 40,000 will be dividend for Rishabh. Law says for the unit holder, income accrues in the same proportion in which the entity earned it. Entity is that pass-through entity, securitization trust, business trust, or investment fund. It is taxable in the hands of you in the same proportion. If I am the pass-through entity, it is taxable in the hands of you in the same proportion I earned it. So divide that. The trust did not distribute, sir. It earned as on 31st March 21, 10 lakhs. It did not distribute. It only distributed in April or May 21. For the year 2021, March 21, the trust earned 10 lakhs. It did not distribute to Rishabh. It only distributed in the year 21-22, April or May. For Rishabh, is it taxable in 2021 or 21-22? Unfortunately, it is taxable on accrual basis. For Rishabh, it is taxable under in 2021. Like TDS, sir, on credit or payment, whichever is earlier, yes. So the concept came as deemed credit. Even if income is not distributed to the unit holder, it is taxable in the hands of such unit holder on deemed distribution basis. Of course, I will tax it only once. Where it is taxed on deemed basis, subsequently when the money is received, you are not taxable. But the catch point for me is deemed credit, deemed distribution. So taxable in the year 2021 itself. Now Rishabh comes and asks me, sir, I got 2 lakhs. Of course, I got the 2 lakhs. I understand it is taxable for me. Sir, how do I know that the company earned capital gains of 5 lakh, 3 lakh, 2 lakh so that I can split the income by 5:3:2? I got the money, but how do I know how much goes as capital gain, how much goes as interest, how much goes as dividend? So you all understand that the company has to give information to you. All these entities are required to provide a statement to the investor on or before 30th June. All these entities are required because your due date is 31st July. Before 30th June, give them the split. This is how you have to split. This is how I have earned, you have to split. Okay, I gave it to investor. Is it sufficient? No, give it to income tax department also. Are required to file annual information report on or before 30th November to the income tax department also give so that I can verify Rishabh's return whether he has declared it properly. Shall I now quickly summarize? Majority of these incomes are taxable in the hands of unit holder. For the unit holder, income accrues in the same proportion in which the entity earned. How did the entity earn? Before 30th June, give it to the unit holder. Before 30th November, give it to the department. Even if you have not received the money physically, it is taxable as deemed distribution. Deemed credit is taxable. Our material, if you take for all these entities, they will again and again write the same point. It is the same thing for all the entities, so I have summarized. It's the same due dates, it's the same thing. And if annual information report is not filed, 5 lakhs is going to be the penalty they will pay. So the penalty is high, making them responsible to give it both to the unit holders and to the. I will first complete securitization trust, investment fund, and then come to business trust. Okay. First, okay, I will complete the securitization trust. What is a securitization trust? It's a SPV regulated by SEBI debt instruments. Securitization of standard assets by RBI. Securitization and reconstruction of financial assets and enforcement of security. SARFAESI Act or RBI guidelines. So debt instruments, all these things will come under securitization trust. For the trust, income from all activities is exempt under 1020. Because I told you who is taxable, the ultimate beneficiary. In our given example, Rishabh is only taxable. So for the trust, income is exempt. For the investor, that is the unit holder, taxable in the same manner as if the investment has been directly made by the investor under 115 TCA. Rate is not given, rate is normal. Rate of TDS, resident individuals 25%, and HUF, other than individuals 30%, non-residents 40%. If it is company or rates in force, we have seen that if it is located in IFSC and the securitization income is PGBP 4%, rates in force. What is securitization trust? All debt restructuring. Simple to understand. Don't try to remember. Now, Sarfasi or a full form, I will try to remember after exams. Okay, right? So, all debt restructuring are coming under securitization trust. For securitization trust, biggest advantage, nothing is taxable in the hands of trust. Everything is taxable in the hands of investor. Rate of TDS 25, 30 rates. I will again tell it in TDS. I am very, very clear about this. They are not going to ask you COVID year rate, which is reduced by 25%. By the time you write your exam, that rates and all are gone. No point in checking. Okay, remember the normal rate. If at all, I'll tell you how to remember the COVID year rate when it comes to when in TDS chapter. Don't. Investment fund. This is interesting. So friends, I'm not answering this fourth question. Okay, specify about securitization trust and its tax treatment. It is the same. You have to just write what is a securitization trust. If you don't remember any of these things, SEBI regulation, RBI regulation, SARFASI, enough. And you know the provision. Everything is taxable in the hands of unit holder. Nothing is taxable in the hands of trust. So write exempt and taxability. If you don't remember the TDS rates, not an issue. So this is, I'm not answering the fourth question. I'm going to the third one. Investment fund established and incorporated in India, which is granted a certificate under category 1 and 2 of AIF. Category 3 and the non-resident we saw, FIAs, etc. Business income is taxable in the hands of the fund. So, business income will not be taxable in the hands of the unit holder. Not double taxation, singular. Business income is taxable in the hands of the fund, not in the hands of Rishabh in our given example. Any other income is taxable in the hands of Rishabh. What if there is loss? Same way, business loss, I will not give it to the unit holder. It is only carried forward by the fund. Business loss will not be passed on, only to be carried forward and set off by the fund. Because business income I have not passed on, how will I pass on loss? Any other loss passed on with a small tinge where the income tax law keeps a small checkpoint. Any other loss will be given to the unit holder. But what should the unit holder do? Provided unit holder is holding the units for a period of 12 months or more. Any other loss will be distributed to the unit holder. Fine. Unit holder. Rishabh says, oh, I can set it off. Huh? Wait, boss. You can set it off, provided you are a long-term unit holder, provided the unit holder is holding a long for a period of 12 months or more. If this condition is not there, what will happen? Everybody has insider information nowadays. Oh, this investment fund is making loss. Huh? I will purchase it on March 1st, sell it on June 1st. So deemed credit, deemed loss will also be given to me. I will set off that losses. No, a person who is participating can only set off. A person who is participating can only set off. So only if you are more than 12 months. Now there is a popular question. If it is less than 12 months, can that loss be carried forward by the trust itself? It cannot be distributed to the unit holder because he is holding the unit for less than 12 months. So can the investment fund itself carry forward that loss? The law is silent. The law is silent. So our institute material has said the law is silent. In my opinion, you cannot. I'm not here to give opinions in this fast track batch, but I'm telling you because the purpose is something else. That's why. But if they ask you, the law is silent. The law is silent. That's the answer. Coming from the reverse, I'm answering question number 3. An alternative investment fund registered with SEBI provides you the following details for financial year 2021. Specify the impact. Business income, STCG, LTCL, IFOS. The investment has a brought forward business loss of 14 lakhs. In the hands of investment fund. Business income 34 lakhs. Yes, brought forward business loss. This would not have been distributed to unit holders. So it is only with the trust 14 lakhs. All other incomes or distribute losses also are distributed to the unit holders. STCG 19 lakhs. Taxable in the hands of unit holder as STCG only. Okay, taxable in the hands of unit holder as STCG only. LTCL 21 lakhs. Okay, LTCL 21 lakhs. This will be distributed or apportioned to the unit holders. A unit holder can adjust this loss against his other LTCG, provided he is holding the units for 12 months or more. Provided he is holding, so 12 months or more. Okay, provided he is holding the units for 12 months or more, he can adjust it. Otherwise, he cannot adjust it. He cannot adjust it. Okay. On the question as to what happens to the loss of a unit holder who is holding for less than 12 months, the law is silent. Write it as it is. Institute material has answered it so only. The law is silent. Income from other sources, 11 lakhs. Taxable, the hands of unit holders. Okay, okay, right. The most questionable area is business trust, real estate investment trust, and investment trust. A small introduction and then I will go to the provision. This is very popular in US and many developed countries. We also started during the erstwhile Mr. P. Chidambaram started this. What is a real estate investment trust? Investing in real estate property, infrastructure development, investment in real estate property, both commercial and domestic. How can you invest? Please keep listening. How can you invest? The trust can directly invest in the properties. The trust can directly invest in the properties, or the trust can have a special purpose vehicle through which it invests. Two ways. The trust can directly invest in the properties. I invest directly. I may get rental income if I let it out, business income, okay, capital gains, anything. I'm not investing. I am investing through a special purpose vehicle. But I should be the holding company of that special purpose vehicle, 51% or more. And they invest, they get the money, give it to me. Investment, this is REIT, investment trust, other type of infrastructure projects like roads, railways, ports, etc. Okay, right. I am just giving you a small story so that you can understand. Okay, I'm just trying to throw you a small story you can understand. For example, okay, me Anju, Rishabh, Preeti are all running a real estate company. We are all running a real estate company. We are all the shareholders of that real estate company. A REIT wants to acquire our real estate company, or our real estate company, they want to make it as their SPV. So how can they make it as their SPV? How can they make it as their SPV? They have to hold 51% minimum, or sometimes 80-90%. So they will get the shares from all the four of us. And they say, in turn, I will allot you units of my fund, my trust. Understand? We four, who are the shareholders of this investment, of this builders company or real estate company, we transfer our shares and gets unit allotted. To facilitate that, what the law does is, section 47 says, transfer of shares in exchange of units of REIT is not regarded as transfer. Repeat, transfer of shares. So all the four of us transferred our shares, got units allotted by REIT. The law says, boss, this is not taxable, because it is not at all regarded as transfer. And subsequent provisions you can understand. When the units are subsequently transferred, cost of acquisition will be cost paid for shares. Okay, that and all you can understand. So this is, now they have acquired shares of this SPV, and this SPV goes ahead and invest in properties. They get money back in the form of dividend, or if they have invested it as loan, they get the money back in terms of interest. Opening up a bit, REIT is a trust, investment trust, REIT, both are same. I can directly invest, some incomes will come to me. I can invest through an SPV, or I can invest through some other entity, etc. Who am I? I am a business trust. Whatever I get, I should give it back to you, the unit holders. Okay? Keeping this in our mind, we approach the provision. The first thing I told you is, which is not as a provision, but I will write it as a note in a question. Transfer of shares for getting units allotted is not considered as transfer, no capital gain. Tomorrow, then I am going to tell you the format of 115 JB. One of the words I am going to use is notional gain on transfer of shares of or units of REIT. Notional loss. Wait till that point. There I will again connect. Yesterday I told this. Okay. Now let's go to RE. Okay. Everything is not an amendment, but major is an amendment. So I have made it everything in blue. Everything is not an amendment, but majorly it is amended because of dividend. I want you to give focus for this because questionable area. So I have put everything in blue. Since dividend income is taxable in the hands of the recipient, there are few changes in the overall provision. Dividend income from a special purpose vehicle. Special purpose vehicle means where I hold majority of the shares. Okay. Now, till last year, because if you are got the material from the institute before, they would have put 100% SPV, non 100% SPV. That provision is gone. Okay, I know you will not, you rarely study material. Your foundation material itself is new in your shelf, but generally I'm saying, okay, where SPV pays tax as per normal provision. Once more, where special purpose vehicle pays tax as per the normal provision. They don't go for optional tax regime. Nobody is taxable. SPV has already paid the tax. After that only they have distributed the dividend. After paying tax only they have distributed the dividend. So exempt for the trust, exempt for the unit holder also. Not taxable. Provided SPV pays tax as per normal rates. Suppose SPV goes under 115 BAA or BAB. SPV pays tax as per alternative tax regime, optional tax. The ultimate beneficiary is taxed. Exempt for the trust but taxable for the unit holder. Quickly, which dividend from REIT is taxable for the unit holder? The dividend where SPV has paid the tax as per alternative tax regime is taxable to the unit holder at normal rates. Interest income, exempt taxable. Rental income, because I can directly invest, let it out also, exempt taxable. Easy to remember, FCA or FC if you remove the A. Before going to the further things, only 3 incomes are passed through, though it is major incomes, but 3 incomes are only passed through. Others are all taxable. Easy to remember. Easy to remember. Only 3 incomes are taxable for the unit holders. Other incomes are all taxable for the trust. What are all the 3 incomes? Interest income, taxable for unit holder. Rental income, taxable for unit holder. Dividend income received by a trust from an SPV where the SPV has paid tax as per alternative tax regime. That dividend is also taxable for the unit holder. That dividend is also taxable for the unit holder. All other incomes are taxable only for the trust. What are all other incomes? STCG taxable for trust if STT is paid. LTCG pay taxable for trust. General LTCG 20%. Any other income, maximum marginal rate 30% plus 37% plus 4%. 30% normal rate, 37% surcharge, maximum marginal, maximum of everything. These are all the TDS. This we saw in non-resident also. Read through once, please. Read through once. Patiently read through once. REIT in between. Started in the reverse manner, will proceed in the reverse manner. Question number 2. In the hands of various stakeholders, how it is taxable? REIT received dividend from an SPV in which it does not hold 100%. This was last year's provision, but still I will answer it now. Till financial year 1920, the holding in SPV is relevant for taxation. From financial year 2021, it is only the tax rates applicable for SPV that determine the overall taxation. Okay, it's dividend from SPV. Okay. Where tax is paid by the SPV at normal rates, then such dividend is exempt in the hands of REIT section 1023 FC and unit holder, where tax is paid by the SPV at concessional rates, that is alternative, or it is also known as optional tax regime. Then such dividend is taxable for unit holder. However, it is exempt for REIT. REIT pay interest on rupee denominated bonds issued to non-residents, where REIT pays interest on RDB to non-residents. The same is exempt in the hands of such non-residents. Same is exempt. Which alone I'll once confirm it to you. Is it only for IFSC or totally? I'll just once confirm it to you. Tomorrow morning I'll answer this. Okay. If two entities exempt like that, it will come. Once I will confirm it to you before, if at all there is a change in answer, tomorrow morning I will tell you. IFSC surely exempt. Other non-residents, I think it's exempt because 10(4)D specified funds, but I will just confirm it. Units are allotted by REIT to various companies for transfer of their shares. Okay. Where units are allotted for transfer of shares, then such allotment is not taxable as it is not regarded as transfer under section 47. Once more, In other words, transfer of shares and in consideration of which units of REIT are allotted is not regarded as transfer. So this is not taxable. This is not taxable for the okay. So tomorrow when I speak about notional gain, notional loss, I'm going to speak about it again. Okay. Sale of such shares. Okay. Subsequently, when the shares are sold, COA of when the units are sold. When the units are sold, COA of such units shall be the COA of shares. Sir, half an hour la பேசிறேன் கிளாஸ்ல இருக்கேன் 12 o'clock முடிஞ்சிடும் நான் உங்களுக்கு பேசுறேன். Question number 1. Bricks and Metals, a REIT, registered under SEBI guidelines and classified as a trust, provides you the following particulars of their income and seeks your opinion on the taxability of the same. Dividend received from non-SPV. Unit holder. Dividend received from SPV. SPV is taxable under normal tax regime, not at all taxable for anybody. Dividend received from SPV. SPV has opted for optional tax regime. Unit holder. Interest received from SPV. Unit holder. Interest received from debentures of unlisted company. REIT at MMR. REIT at MMR. 42.744%. Unlisted company, not from an SPV. From an SPV means pass through. STCG on shares and securities on which STT is paid. Taxable for REIT at 15%. Exempt for unit holders. Taxable for me, REIT. STCG on other investment, MMR. MMR. Rental income, back to unit holders, not tax. 1023 FCA, others are FC, this is FCA. LTCG on which STT is paid. 9,80,000 or 1 lakh I can claim exemption and balance 8,80,000 taxable. Anupama, one of the unit holder received 30 lakhs as distribution. This apart, in the previous year, she has sold the REIT which result in STCG of 320. Specify the impact and the, okay. Please look at, I have done this detailed in the classroom amendments. Okay. Dividend from non-SPV, MMR, sorry. Dividend from SPV only pass through. MMR, this is taxable in the hands of REIT. REIT, MMR. Dividend from SPV, where SPV has opted, exempt. Exempt. Interest exempt. Okay. Interest received from debentures, taxable at 42.744, MMR. MMR. STCG, taxable at 15%. income on STT paid. Other STCG taxable at MMR. Rental income pass-through status. LTCG 1 lakh is exempt out of 9 lakh 80,000. Remaining 8 lakh 80,000 into 10%. 1 lakh is exempt, remaining. Okay. The total income exceeds 1 crore. Okay. So the surcharge is 12% and the HEC. Look through the answer. Dividend from non-SPV MMR. All other dividends exempt. Unlisted debentures MMR. STCG, other STCG MMR. Special rates are special rates. Remember to provide 1 lakh for LTCG. How is Anupama taxable? Because how many units she is holding? Anupama is holding 30. Okay, Anupama got 30 lakhs as distribution and it should be split in the same ratio. Okay, the unit holder earns the income in the same proportion in which the trust has earned. Okay, the trust has earned from non-SPV. Totally trust income is 1 crore 8 lakhs. Totally trust income is 1 crore 8 lakhs, of which 21 lakhs is this dividend. 30 into this is taxable in the hands of REIT, so it is exempt in the hands of Anupama. It is exempt in the hands of Anupama. Okay, because REIT has paid the MMR. You can see REIT, this is from a non-SPV. So REIT has paid it, so I am not taxable. Which has not opted for optional, normal tax region, again exempt. This is taxable in Anupama's hands. Interest is taxable in Anupama's hand and rental income is taxable in Anupama's hands. I think there might be a, so far whenever REIT is questioned, it is only theory question. It is only theory question. So please be clear and please be clear with the rates of taxation also. 10% is the rate of taxation for non-resident also. They are getting special benefits. 5% because all infrastructure, I ask you to remember, interest is 5%. Interest is 5%. All infrastructure for non-resident, it is 5%. So far, they have only asked the theory questions. Please remember this. There can be a theory question in REIT also. There can be a theory question in REIT also, or asking you to explain the tax treatment of each item. Okay, okay, okay. Today I wind up here.